Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets of corporate America. And if you appreciate getting straight insights from corporate documents, make sure you're subscribed. And we also have a Discord community linked in the description below today. We are diving into Matthews International Corporation's latest annual report, a company that has been around since 1850 and is involved in everything from caskets to industrial tech and brand solutions. Their latest filing shows some pretty big shifts and some numbers that tell a story. Let's see what is really going on beneath the surface here. Matthews International is facing a year of significant change, particularly with the divestiture of a huge chunk of their brand solutions segment. This sale alone has a major impact on their reported numbers for the year ended the 30th of September 2025. Consolidated sales took a hit, dropping from $1.8 billion in 2024 to about $1.5 billion in 2025. This $200 million decrease is largely due to that divestiture of the SGK business on May 1, 2025, as mentioned in their report. On top of that, they saw lower sales in their industrial technologies segment and memorialization segment. In the memorialization segment, sales dipped slightly from $829 million in 2024 to $809 million in 2025. This is attributed to lower unit sales of caskets and memorial products, which the company links to a decline in US death rates. While that sounds grim for business, it is a demographic trend they've been preparing for. The industrial technologies segment saw a more significant drop in sales, down from $433 million in 2024 to $342 million in 2025. The company points to lower sales of engineered products, especially for the electric vehicle market and battery manufacturing equipment. They've also discontinued some auto engineering solutions. The brand solutions segment experienced the most dramatic sales decline, falling from $532 million in 2024 to $345 million in 2025. This is directly tied to that major divestiture of the SGK business. What is left in this segment is their cylinders business and their new 40% ownership in Propellus. Financially, the company reported a net loss of $24.5 million for 2025, a notable improvement from the $59.7 million loss in 2024. This is good news, but keep in mind it comes after selling off a significant part of their business. Looking at adjusted EBITDA, a measure of operational profitability, it fell from $205 million in 2024 to $187 million in 2025. While down, it is important to note that the memorialization segment actually saw an increase in adjusted EBITDA, showing its resilience. The brand solutions segment adjusted EBITDA figure reflects the impact of the divestiture, but also includes their share of Propellus's performance. Cash flow from operations turned negative in 2025 at a use of $23.5 million, compared to over $79 million provided in both 2024 and 2023. This dip is partly due to significant transaction costs related to that SGK business sale. Investing activities for 2025 show a massive inflow of $159 million. This is largely thanks to the $228 million received from that SGK business sale. This influx of cash is a big deal and will impact their future financial flexibility. The company's long-term debt remains substantial, sitting at over $700 million. While they have a large credit facility, the interest expense has increased to nearly $63 million in 2025 compared to $50.5 million in 2024, reflecting higher average interest rates. They have a substantial $750 million revolving credit facility maturing in 2029, which is a good sign for their liquidity. However, the report mentions that borrowings under this facility are subject to variable rates, meaning interest costs could rise further if rates go up. Shareholders' equity took a hit, shrinking from $437 million in 2024 to $480 million in 2025, mainly influenced by the net loss for the year and significant foreign currency translation adjustments. Goodwill, which represents the excess of the purchase price of an acquisition over the fair value of its identifiable net assets, saw a massive decrease from $697 million in 2024 to $487 million in 2025. This is primarily due to that SGK business divestiture, which removed a large chunk of the goodwill associated with that segment. They also had a goodwill write-down of $16.7 million in the industrial technologies segment in 2024. Now, let's talk about risks. Matthews is facing serious legal challenges, particularly from Tesla concerning trade secrets and patents related to their battery electrode technology. There are multiple lawsuits and arbitration proceedings happening, and the company admits they cannot estimate the potential loss because of the lack of specificity in the claims. This is a huge red flag, as the cost of defending these claims and any potential adverse outcome could be substantial. The report states that sales related to this disputed technology were about 4% of their sales in 2025. So, while not their entire business, it is a significant concern. Labour costs and availability are also a concern. The report highlights the risk of labour shortages, turnover, and increased labour costs. This is a widespread issue not just for Matthews, but for many companies as the economy tightens and workforce dynamics shift. They also rely heavily on third-party services. This means if a vendor has a cybersecurity breach or service outage, it could directly impact Matthews' operations, leading to disruptions and potential damage to their reputation. A major ongoing story here is the strategic repositioning of Matthews International. The sale of the SGK business and the creation of the Propolis joint venture are massive moves. They are trying to streamline their business, shedding segments that may be less profitable or strategic while holding on to resilient ones like memorialization. The industrial technology segment, especially the energy storage solutions for EVs, shows promise but is also facing headwinds from project delays and customer disputes. The legal battle with Tesla is arguably the most significant immediate risk they face, and how that plays out will have a material impact. Overall, Matthews is navigating a complex transition. They've made the bold move to divest a large part of their company, aiming for a leaner, more focused future. The strong performance of the core memorialization business is a positive, but the challenges in industrial technologies and the significant legal risks, especially that Tesla dispute, cannot be ignored. Their future direction will heavily depend on how they manage these ongoing legal battles, integrate new acquisitions, and capitalize on emerging opportunities in sectors like renewable energy tech. What is your take on Matthews International's strategic shift and the massive legal battle they're in? Let us know your thoughts in the comments below. If you found this breakdown valuable, give us a thumbs up and subscribe for more deep dives into corporate filings. And don't forget to check out the Corporate Decoder Discord in the description to keep the conversation going. Thanks for watching, and well, see you next time.